Everyone is looking for the perfect trade setup. But here's the thing, the perfect setup is different for everyone. In this video, I'm going to share my perfect trade setup, the one I've refined over more than 20 years of trading. Yes, I've been trading since I was 16. And a lot of what I share comes from my time at JPMorgan as a bank trader and later on as a retail trader. These principles have stood the test of time, and I'm excited to share them with you today. Before we dive in, don't forget to subscribe to the channel for more trading insights, strategies, and tips. So, a perfect trade setup is all about getting three things right: timing, price, and direction. When you nail these, the trade moves in your favor almost instantly with little to no retracement. Now, why is this important? Because when a trade moves against you, doubt creeps in. You start second-guessing yourself, questioning whether it was the right trade to call to begin with. That's why catching the market flow at just the right times is crucial. This precision is something I focus on every single day, and it's paid off. In 2024, I made 3,400 pips, winning every single month of the year. In fact, my zip trading strategy hasn't had a losing month in 19 months. Of course, I have to remind you that past performance does not guarantee future results. These results don't come from blindly following signals. I wish it were that simple. Instead, it's about knowing when to trade and when not to trade, and picking setups with minimal risk of retracement. This means choosing trades that move in your favor swiftly with minimal risk of reversing against you. We know that the perfect trade setup is one that moves quickly in your direction. But how do we achieve that? How do we identify that trade? Well, the trick is to ensure that market momentum is on your side. For instance, you should only buy US dollars when US yields are rising and sell US dollars when US yields are falling. Here's why this matters. Take a look at this chart. It highlights the strong correlation between 10-year US Treasury yields and the US dollar. This chart shows you that their movements are closely synchronized. So while you could sell US dollars when US yields are rising, the smarter move, clearly shown by this chart, is to buy dollars when yields are rising and to sell them when yields are falling. Why? Because US Treasury yields reveal how bond traders are positioned and how they're aligning themselves. So you want to align yourself with the flow rather than fighting against it, which is crucial. The best trades happen when you move with the overall market, not against it. The next step is to buy strength and sell weakness. There's usually a very good reason why a currency is up a lot or down a lot, and more specifically, why it is up more than other currencies. It could be economic data, it could be political troubles, it could be central bank comments, it could be interest rates. Regardless, and even if you don't truly understand it, and I think most people don't, it's always better to sell the weakest currency and buy the strongest. Let me give you an example of how this would work. So on this given day, the Bank of Japan governor came out and said that their next interest rate meeting is a live meeting, which is their way of telling us that they are thinking about possibly raising interest rates at the upcoming meeting. The Japanese yen soared overnight on that comment between the hours of 11 p.m. and 3 a.m. New York time, which is the Asia session. So when I woke up from a very good night of sleep, because for once, my 6-year-old didn't crawl in bed with me and kick me, I turned on my computers around 6 a.m. New York time, and I saw that the Japanese yen was the strongest currency. I looked for the reason, which was the BOJ's comment, and then looked to see if there were opportunities to buy the Japanese yen. Now, this day we also had US inflation data scheduled for release, so I knew I had to wait for the report to come out before taking the trade, because that's one of the most important things. The data like that could change the outlook significantly. And one of the tips I have to give you is that when you have such an important piece of event risk, important piece of data, it's really important to know when to trade and when not to trade. So you never want to be trading ahead of a big report that could completely shift what the charts look like. The CPI inflation report comes out, it's weak, and the US dollar falls. So I instantly sell dollar yen because number one, we had the data on our side. Number two, US yields are tumbling, which is what I want to see when I'm looking to sell US dollars, because it means that I'm riding the current market sentiment, not fighting against it. Number three, I had the technical setup. Dollar yen was in my zip sell zone, which means the background on my 1-hour chart is red, as you can see here. And dollar yen is also trading below the indicator line. This is the way I've been trading for over a decade, and my strategy, and it's the strategy I use every day, but you can replace it with whatever trading strategy is set up that you use. However, if you want to learn my strategy, check out the links in the description below. Lastly, number 4, I check my moving averages across 3 time frames, the daily, 4-hour, and 1-hour chart, to make sure that I am not selling into moving average support or buying into a moving average resistance. This is what I like to call moving average clearance, which I did in this case. I sold dollar yen and it dropped 100 pips. I had moving average clearance. I only took a sliver of that, 60 pips, but I was satisfied because I re-entered the trade later when the price bounced on a retrace. This approach emphasizes a structured, disciplined strategy, buying strength, selling weakness, and making sure all the elements align before entering a trade. So to sum it up, the perfect trade has 4 components. You start with a technical setup, and you look for a clear buy or sell signal. Then you take the trade if it's aligned with the market flow or sentiment. But make sure the fundamentals, which is the data and the news flow, actually supports your trade. And then you want to check the higher time frames to make sure that there's clearance and there's no major support or resistance that could be blocking your trade. And here's one extra tip. Wait for retracements. While it's great to buy strength and sell weakness, no one likes to pay up. So use your technicals to time your entry on a pullback, because that can improve your risk-reward ratio. This is where looking at a lower time frame can be helpful, like the 15-minute or 5-minute chart if you're trading off 1-hour charts like me. So there you have it. This is the process I follow for every trade. I trade the New York and Asia sessions using my ZIP strategy, only taking the trades where market sentiment and fundamentals align. It's not about quantity, it's about quality when we trade. If you're tired of second-guessing your trades and ready to start trading with confidence, check out the description below for more details on ZIP. And don't forget to subscribe to the channel so you don't miss future strategies and tips. Thanks for watching, and I'll see you in the next video.